because I think that's a challenge. Look, fundamentally, one of the reasons that I think we haven't made progress is because different regulators define what a digital asset is differently, and that's an issue. And if the regulators can't decide how they're going to classify something, frankly, the investors themselves who have to report into those regulators are going to be a little bit flummoxed. So I think that's been a challenge. I mean, Gary.
This is Liquidity Talks, a live stream and podcast series designed to share the latest trends and updates from the world of Treasury, liquidity and risk. Join us as we power up the liquidity conversation.
Hello and welcome to our latest instalment of Liquidity Talks, live stream and podcast. I'm Neville Roberts, CEO and founder of Planix, the market-leading fintech focused on real-time treasury, liquidity and risk. Now, before we start today, I just wanted to mention that on March the 13th at 11 a.m. Central European time, we're going to be live on a webinar to help banks navigate the recent ECB guidance on intraday liquidity. We're going to explore the key challenges, provide practical insight on how to address the guidance. Now, the session's predominantly designed for banks under ECB regulation, but it's valuable for any bank to learn how we are addressing that. So going to be a post coming in the comments any second now. And if you want to get onto that webinar, please join us on the day. Now, our topic today is entitled, How Do Digital Assets Impact Liquidity? It's quite a broad subject, but there's some really good meat on this. Welcome to our audience today. Good morning, afternoon and evening, wherever you may be. Today, we have a record new audience attending. There's many of hundreds who join us live on the event, but afterwards, when you take into account people who attend after the event and look at it afterwards, we get well over 1,000. So thanks for joining today. Anyone in the audience can ask a question. As you know, if you put it in the comments section you see on the right-hand side of your screen, I can take questions as we go and also at the end. We have 30 minutes today. And if you do want to ask a question, please let us know who you are and if possibly your role, so we have some context to the question. Now, today I'm joined by our guest speakers. We have two today, Gary Wright from ISITC Europe and Roy Zimmerhansl from WTS Hansuke. So, Gary, Roy, would you like to introduce yourself? Tell us a little about who you are and what you do. Gary, do you want to go first?
I'll start if that's okay, Nev.
Yep.
Well, I'm Gary Wright, ardent Spurs supporter, so you can throw anything you like at me. We're taking it all this season. But I am director of ISITC Europe, have been founder of ISITC Europe way back over 30 odd years ago. But most of my career has been in and around capital markets, running operations for major banks. And I'm going to give a little plug to my first firm, Charles T. Pulley, a small jobbing company way back in 1969 that I joined.
Brilliant. Roy?
Hi, Roy Zimmerhansl. I work at WTS Hansuke, which is a London-based sort of financial services consulting firm. So we focus our sort of deep hands-on experience, as I like to say, on capital markets and sort of frontline banking. I've sort of not quite as long as Gary, but I've been doing this for I'm into my fourth decade of doing that, and so I started running the streets in Toronto in the winter as a messenger.
Wow, brilliant!
And now I run the capital markets practice at Hansuke.
Perfect. Now I do like to talk just for 1 minute on football, and I'm afraid, Gary, I'm not going to let you off the hook that easily. I was going to talk a little bit about Spurs, but there's probably not that much to talk about, apart from the biggest upside for you this year should probably be the fact that Liverpool should win the title and not Arsenal, right?
Absolutely right. I'm a pseudo Liverpool supporter for this year.
Perfect. And Roy, I believe you're not into football apart from the one that we throw, which is the Dallas Cowboys, right?
That'll be the one, yes, for my sins.
And probably the best stadium in the world, right?
Listen, I've been there. I was there at a Super Bowl to see Green Bay beat Pittsburgh, and I felt like I should take my shoes off on going into the stadium. It was that beautiful and pristine, so it was amazing.
Excellent. Well, we'll leave it there so I don't cause any upset with you, Gary, on football. But look, onto the subject today, digital assets. Let's get straight to it. First of all, it'd be good to hear just your view of what a digital asset is, to level set with everyone, but also to the crux of the question today, which is really about how will digital assets impact liquidity in the traditional markets? And secondly, what could be the impact on market intermediaries as well? Roy, if you want to go first.
Do you know what? I think Gary's probably been defining what digital assets are, right? Because I think that's a challenge. Look, fundamentally, one of the reasons that I think we haven't made progress is because different regulators define what a digital asset is differently. And that's an issue. And if the regulators can't decide how they're going to classify something, frankly, the investors themselves who have to report into those regulators are going to be a little bit flummoxed. So I think that's been a challenge. I mean, Gary, find a way to explain it to me as if I was 6 years old.
Well, I mean, that's in a nutshell. Digital assets are they could be anything essentially. So you can align and create a digital asset from virtually any product. So it could be a utility type product. It could be art. It could be a non product, or it can be an equity or a bond. So it's very, very generic, and that thereby does lie the problem, is because it's almost a solution looking for a problem in many respects, and it's why the markets are both excited and a little concerned about it at the same time. The excitement comes because it has potentially a opportunity to restructure and redefine what the capital markets and what finance is, and how you finance product and how you invest on a 24/7 basis, how you bring transparency into investing and raising capital. A lot of people talk about digital assets in market terms. Well, it could be a market term. So there are certainly stock exchanges and others that are looking to create a market for digital assets. But the market for most people is what we know today, the traditional market. It may not, in the fullness of time, it may not end up as a traditional market. It may be more bilateral between those issuing and those investing. So it's a very difficult thing to define, and it makes regulation or creating regulations domestically, but most importantly internationally, extremely difficult. And it's going to take, I think, a long time for the regulators, the markets, the investors, the issuers to actually hone it down into what it is and how it can be used. But it is, for me, I've often say I wish I was 20 years younger with this thing, because it's got all the hallmarks of Gary Wright interest, in that I can see wholesale changes happening within the way that the traditional markets currently operate.
Yeah, and so what about the impact on the liquidity side of this? So these are relatively new. The impact on liquidity, do you think we understand that well? We just had a comment here saying liquidity is 24/7 basis, but T-bills and bonds are T+1. So the impact of these digital assets on liquidity specifically, what are your views on that? And do we know what's coming?
Well, Roy and I are both on the UK T+1 task force, and have been on that for well over a year now. And the report that was published recently about UK moving to T+1 on the 11th of October 2027, EU going on exactly the same day as are the Swiss. So liquidity has been very much in the thought around as the markets move to more towards real-time processing for T+1, but with a real issue around real-time settlements and real-time executions, real-time settlements. Now, the goal here is not the domestic markets as such. It is the international investors. It is the international product raising. So it's in a way the traditional markets that we've been working on with T+1 for the equity markets and bonds, etc. The solutions lie in the digital world, where that has more transparency and that has more 24/7 capabilities on an international. So we've got this dichotomy really of operating in real time, which is the need of investors. But how did we actually get to that point? So the how and the when is what gets me up in the morning to try and work out how and when this is all going to happen. What I am convinced of, it is going to happen. I just don't know how and when it will happen. But the impacts on liquidity will be profound.
Yeah, and picking up on that, I think profound in many different ways. As the person that's commented here says, it's a 24/7 world, and of that 24/7, really the biggest challenges today, in fact, are within that 24 hours. Right? It's actually the shortfalls and the excesses intraday that are frankly impossible to resolve in the sort of analog world that we're in today. How do you get intraday funding? You have, as any bank of any kind of size will have, ebbs and flows of cash surpluses and shortfalls throughout the course of the day, and are often just lumbered with the financing cost of that. You get into something like a digital asset or a token, or the ability to actually move ownership on records rather than actually move anything. All of a sudden, you now have the opportunity to fund those positions, reduce your costs, and have better control and get a proper liquidity management process. So I think that's the potential. But look, there's loads of challenges there. And a big part of the challenge is sort of the network effect. It's like if you have the most sophisticated fax machine in the world, but you're the only one with a fax machine, it's not much good, is it?
Exactly.
Yeah.
And I think ever since we've been around, we've seen everything moving real time. So instant, faster payments. It's not, there's no concept of an end of day. It just flows all the time. So you have to react all the time. It's not just within that day.
That's a key point, actually. Neville, is that we're asking batch systems, old legacy systems, to operate in a real-time basis. And we've also on the comment, and we've already said that we're looking at 24/7. We're looking at international markets. We're looking at now that can't operate on a batch system. It needs real time. It needs real time. It needs transparency. You need to have that access to the products and being able to execute and settle within a real time. So the liquidity issues on the capital markets are exactly the same as they are in the FX market and in the payments market. So what we're doing is bringing all these things together, where once we thought about them as sort of three ends of the transaction. Actually, what they are in liquidity terms are the transaction. It's all together.
Yeah, and going back to the T+1, I think what we're going to end up doing is finding all the faults with the current business the way it's done today, and all the potential issues it solves. One of the issues we face with T+1, where I also have the pleasure of being the co-lead of the European, the EU committee on T+1 as well. So both UK and EU. Frankly, the FX markets look at securities markets and say, yeah, we know you're part of our flow activity, but frankly, you're not a big enough part for us to actually change what we're doing. So for now, we're going to stay T+2. Well, now you actually have the securities markets detached from the FX markets. So as Gary says, this is meant to be all one flow. Well, we're ripping that apart. That's harder to do now.
But also, I think. Sorry, no. I think on location, we often talk about markets. The US market being a big market, and IPOs gravitating towards the US market, and what have you. So we've tended to talk about markets as being on a geographical location. Whereas with digital assets, what we're talking about is not markets as such. We're talking about interoperability across platforms. So we're talking about this as being no location issues. They could be anywhere in the world. So the market for digital assets could be in Saudi Arabia, or they could be anywhere in the world. That's how we would define that might be around regulation, around the protection of investors and issuers, and so the regulation might become the key to which will attract investors in digital assets. So the whole world in finance is really up for grabs here. I think this is the point I want to get over, is that, and you can see this as a threat. If you're in the traditional market in some way, and you think this is not going to happen, or you put your head in the sand and just pray it's not going to happen, it is going to happen. So what firms need to do now is to incorporate this and to think about it, and to think about digital assets. Is it simply another asset class, or is it something much more than that? I've got a feeling it's much more than that.
Yeah.
Look, at my last firm, 10 years ago, when they were talking about the future of custody, in this case, it was about the roadmap of how we were going to migrate from our technology, our legacy technology, to new technology. And I was saying, well, you're not going to do that. You can't do that, because what we've done with technology through my whole career is make the existing bad processes a little bit more efficient and faster. And we've got rid of the noise, where what we really need to do is have a rethink of how it actually should be done, have digital assets become the users of that new tech, and then actually fold the traditional finance world into that space. That's the actual thinking. But look, I got to tell you, the reality is, if you're a bank, your run the bank costs have gone way up. Like, life's more expensive as a bank. Regulation over the last sort of post GFC period has been, overwhelming in terms of cost and complexity. And now we're going through all of the refits. So your run the bank costs have actually gone way up. Your ability to actually change the bank with your existing clients, with your existing volumes, is constrained. And so the money left over to think about the future is, it's small. It's competitive, right? Because you have to keep doing that. And don't forget, if you're a market leader today, you're a market leader in today's conditions. Do you know what's your incentive to go to a world where it's easier for everyone to have a level playing field? Because everyone's starting from scratch.
So look, if you can ask, many of the attendees on this podcast are banks, and I'm sure they're sat there thinking, well, look, so this is happening now. It's happened. It's the future. How do I prepare for that? So digital assets coming on board, the technology I need, the process changes, the mindset I need, the regulations. What advice would you give? How do I think about preparing for it? Because I'm probably up too late, maybe.
Firstly, don't be afraid. Learn about this. Hold your hands up. Go and learn about this. Assess what the opportunities are and what the threats are to your existing business. So you can only do this by being upfront and getting out there. This is not sort of read it from a book. This is getting out there and do your homework and work out and assess, and then plan. Because it's potentially, if you don't plan for this going forward, and you haven't made a decision on how it impacts your existing business, it's going to be very, very difficult for you if suddenly you see your competitors and the market moving past you at an ever-increasing pace. You won't be able to catch up. So you need to do that now. And it's not too late, because as we said in our opening comments, this is a moving target. It's not absolutely solid yet on what it will look like, how it will come about, and when it will come about. But we see enough indicators. We've got enough evidence. We see the ECB this week about central bank money in digital form. That is going to be fundamentally important to how the backstop of liquidity, backstop being an operative word at the moment, but how the backstop is operating. Also, the Trump intervention around things were going along swimmingly with the US moving in the general direction of everybody else. Now it's going in a slightly different direction with crypto and what have you. So this is going to happen. It always happens with entrepreneurs in a developing, growing market. It's not solid. But you've got enough evidence there to start making some assessments.
Yeah, and I think there was a speech at our last T+1 by someone from the FCA, and his I guess diktat for market participants, I think really applies to the digital space. He says, as far as planning for T+1, you should read everything you can get your hands on. You then need to plan where you need to go and what you actually have to replace, build, investigate, whatever. Third thing you have to do is budget for it to make certain that you can actually afford to do that. And then the fourth thing is act. Why haven't you done it already today, right? And so I think that applies to almost everything. And I think the thing is, with all of these products, it's about what's a tipping point. So there's lots of use cases, right? I've got something in front of me with 8 different use cases for either tokenized assets or where you can use DLT to change ownership, and that's great. Those are all 8 use cases, but I suspect that that's one use case from 8 different banks, right? And so the problem you have there is there's no commonality in terms of what we should tackle first. So I think part of the challenge is getting people to say, look, this is a problem that we can all get together and solve, and it's a small one, but then that becomes the building block for the next thing, and they all become proof cases. And rather than try to have a big bang, we're going to change liquidity, we're going to do intraday liquidity, and that's where we're going to go from here to here. And today in the analog world, you can optimize your collateral, but you're not doing that. Not everyone's doing that, right? And yet all of a sudden you're going to go to an asset where you have hardly any assets and put all of your time and effort into that. The payback is nothing, right? So I think that's the challenge. Really, you have to get people together and say, what do we need to do to get something to a tipping point that will then say we've got the ball rolling.
Good. Well, we've got it. If I could just ask this question from Dominic Broom, one issue that needs to be addressed, at least until there's a legal and regulatory alignment, is where a digital asset is deemed to be issued.
Yes.
Does that resonate with you?
Yeah. Well, that goes back to my issue around the regulation of this and why it's important that the international regulation, that there's compatibility across markets, because if we don't have that, it's going to stymie investors. It's going to stymie the use of the product. I'm pretty sure that will happen, and fundamental to that will be ownership. Is where is it owned, under what jurisdiction, what rules? If it's international jurisdiction, which is what I'm calling for, what I'm hoping for, that problem goes away. That concern disappears. But one of the things that I think we should be aware of in liquidity terms is as we get digital asset growing and it's sucking in investment cash, it's sucking in money, sucking in investments, sucking in capital raising. That sucking in is away from the traditional markets. So what we might have is two things operating in parallel, with one growing faster than the other one. And if the digital grows faster and it goes past the traditional market, then the management of liquidity is going to be very, very difficult, because you've got another important factor you're going to have to appreciate in your, not daily, but almost minute by minute measurement of liquidity in both the asset and cash.
Yeah, and the example that people that have known me a long time have heard me say, so I apologize to those of you that have heard this, but I was in Canada at the depository when we went from physical certificates to book entry, right? And when it was first announced, everyone's going, "That's fantastic. We don't want these certificates anymore. We can get rid of our vaults. We don't have to do certified checks anymore, all that." And so everything was great. And then the reality of it came out, which was, well, in fact, if you think of going from certificated to electronic, if everyone just had cash, you have to start putting that cash into the bank. You have to make deposits, and then not everyone's going to take electronic receipts, so you have to actually pull it back out, right? And so you had deposits, withdrawals, and then reconciliations, which you never had to do before. And you couldn't get rid of your vaults because not everything was certificated. That took many, many years. So you still had the vault space. So it meant you still had to have people there. And all of a sudden, as Gary says, you're now operating two systems that are both less efficient than they were, right? So your costs actually go up. And so it was a nightmare. They had to hire more people. Your costs went up because now you had these depository charges, which you didn't have to have. Like, to make a very long story just a little bit less long, what happened though is you look back 5 years later and you go, geez, we couldn't get to today's volume with the people we have, with the cost base we have, had we not started that journey 5 years ago. But there's no question that there is a transition period. I worked on I was a product manager for a product for a client where what they did was ask me to create effectively an alternative to a US government money market fund that would become a transferable asset. Right. Yeah. And so as part of that process, we were looking for fund managers. We found a fund manager that was working towards a digital fund launch. And they said, great, we can manage it. And now we can distribute it that way. And the cost dynamics where we were going to issue the bond in today's world only to institutional investors, they were going to get down to retail investors and fractionalizing it for like $3 an investor. Yeah. Like that's fundamental. But what happens to the residual funds there? So do all the rest of their funds become more expensive, right? Because now you're taking the volumes out.
Yeah. So do you think regulations and legal frameworks are up to scratch? And it actually just links to this question I've seen from Raza Hassan, which are there certain jurisdictions which are doing much better, sensible job of regulations, and can we leverage them? Are they in place yet? Are they good enough, or is there a lot more work needed?
A lot more work, I would say. The key to this is collaboration. It's really collaboration across jurisdictions, because the win is in the international markets. It's very much that's the plum that people want to go for. But as part of that, you can realign your domestic market to make it, streamline it, take out a number of the costs. Now, to be able to take advantage of that on the regulation, it's difficult, because regulators tend to they're not entrepreneurs. Regulators, they're kind of the opposite of entrepreneurs. So what you need is really the regulator and the government to be able to allow the markets to evolve and develop at the best pace possible in the best way. So they don't want to sort of shoehorn it. They don't want to make it too restrictive where this can't find its own level. But it does need regulation at the same time to enable the necessary protections to those that are going to use it. So it's a tricky one. It's a lot of work to do, but it does mean, I think, a collaborative model is the one that would work best.
Yeah, sure. I don't think anyone wants to say that they live in a market where their regulators are entrepreneurial, right? Because it is that level of confidence that actually then investors feel comfortable coming in, but has to be consistent, because again, what we don't want to have, and I think regulators post GFC have gotten better at this, we want to avoid regulatory arbitrage. I'm going to go to that jurisdiction because that favors my corner of the digital world.
So, look, in your view, if it's possible to get a one-word answer, do you think digital assets ultimately they're a solution, they're a problem, or they're both actually?
Well, they're a problem if you are wedded to the traditional market and you believe that this is the way it's going to be forever and a day. That's a problem in my book. If you believe that, like I've seen technology since 1969, some work, some don't work, but even the ones that don't work move the dial. Things change and things evolve and things develop. So the world today is nowhere near what it was like in 1969, and you have to encompass the future for me. So you have to look at this as a solution. You have to look at it as something that you're investing in because it's the future, and there's a greater opportunity to do more business, make more money, bring more investors into the market, supply SMEs with better capital raising. This sort of fits into most governments. They want to increase the amount of companies coming to market, more capital raising coming. It's a more streamlined. I keep calling it a market, but it's not really a market in my view. It's a platform. There's a series of platforms. But I would say yes, it is a solution, but that solution is yet to be defined. That we're still on that path. I think but it may come sooner than most people think.
Okay. Yeah, I mean, I look at it this way. If you go back 10 years ago, it was a technology issue. It was no question. It was a technology. There were lots of great ideas, but not a lot of practical applications. I don't think it's a technology issue. It's a behavior issue, and that behavior will be influenced by the regulation because the technology is already enabled. And then to me, it's about, is it an economic case? and that's really the nub of the issue, because until you can get the value out of the proposition and have a clear case for that, I can't see wholesale, gung-ho, let's make this happen kind of activity. And so that's why you're likely to see that being driven by more of the retail side of things. So those that service the retail are the ones that are actually going to be embracing it, generating the income, which is why they're going to continue to outpace. And then I think they get acquired by all of the TradFi firms that they're trying to replace. Right.
Yeah, I mean, there's one thing Roy and I have discussed a little bit in the past is the impact on the intermediaries of digital assets. I mentioned earlier that there could be a bilateral arrangement between issuers and investors on a platform, which effectively cuts out the intermediary. So intermediaries in the market need to really think about their role in the future, what their business will look like in the future, if, as I suspect, digital assets become the power beast in the market, then that's going to impact intermediaries, and they need to plan for that and think about that now.
Well, and that's the question raised by Morris Leo in the questions, right? And so I think that's the thing. But I'm a little skeptical, right? Intermediaries have managed to find a role for themselves throughout capitalism, right? And I don't see why digital assets are going to be any different, but it does require a thinking and a forecasting of what the future is going to look like and how are you going to fit into that. But look, Jamie Dimon had his famous comment about Bitcoin. And then it wasn't that much longer that they and almost every other bank is servicing customers in there. They may not be doing it for themselves because they have their own views and concerns and questions and lack of infrastructure. But if you can make money from a customer doing it, I'm in.
Perfect. Exactly. Well, look, we've got quite a few more questions coming in. We are running out of time. So before we conclude, I would ask my favorite last question, which is, if you were to give the audience today one key piece of advice, what would it be?
Don't put your head in the sand. Look at this. Be brave. Don't hold on to what you got. Think about what you can get.
Perfect. And Roy?
Yeah, I'd say the same thing. It's that read, plan, budget, and act. And there will be a benefit, I think, to first movers here, as long as you can weather it until you get the second, third, fourth, and fifth mover, right? You can't be out there alone. But but I think there's enough value in small clusters with like-minded purpose that you can make this a go, and then everything becomes self-reinforcing.
Perfect. Well, unfortunately, we have run out of time today. So, Gary, Roy, thanks very much for joining us today and sharing your views. There are some questions we'll have to answer after the event, and if anyone's got any more, just post them through. And we'll get the comments and answers back to you after this event. So that concludes our latest Liquidity Talks live stream and podcast. We'll put everything on all these podcasts on LinkedIn, Spotify, Apple Music, and other media outlets and streaming services very soon. Thank you very much for joining. Look out for our next podcast next month. It's going to be called Achieving Regulatory Resilience, Banks and Liquidity Management, and we'll be joined by Steph from Red Queen Advisory. My name is Neville Roberts. Thank you very much for tuning in, and goodbye.
Goodbye.
Bye, and thank you.
You've been listening to Liquidity Talks. Don't forget to subscribe to stay updated on the latest developments and industry opinion from the world of Treasury, liquidity and risk.